Welcome to the deep dive. We're your shortcut, really, to getting under the skin of those complex financial reports.
Yeah, those dense filings most people just, well, glance at.
Exactly. We dive in so you don't have to, pulling out the key bits, the insights.
What it all really means.
And today, we are tackling Atul Ltd. Specifically, their just released Q1 FY26 results. That's for the quarter ending June 30th, 2025.
Right. And our goal, like always, is to help you understand not just the raw numbers, but, the story behind them, what they signal for a tool, maybe even the wider chemical sector.
And the info, straight from the source.
Absolutely. It's all based on Atul's own filings to the BSE and the National Stock Exchange of India. Plus, we've got the review reports from their auditors, Deloitte Haskins and Sells.
Okay, let's jump right in then. Let's unpack this. What's the immediate headline? The big takeaway from Atul's Q1 report? Because I noticed some interesting contrasts right away.
You're right. What really stands out initially is the difference you see between the consolidated numbers and the standalone one.
Yeah.
So consolidated, that's a whole group. Subsidiaries, and all, they pulled in revenue of 1,478 crore for the quarter. Pretty robust.
1,478 crore. Got it.
And that resulted in a net profit after tax of 132.36 crore, giving an earnings per share, EPS, of 43.4.
43.40. Okay.
Now, compare that to the standalone results, just the parent company's core operations. Revenue there was 1,304.56 crore.
A bit lower, naturally.
And the net profit was 97.74 crore, with an EPS of 33.1.
Right. That standalone versus consolidated difference is always key, isn't it?
Okay.
For anyone maybe newer to these reports, just a quick reminder, standalone is the parent company, consolidated brings everything else in subsidiaries, joint ventures,
Yeah,
the full picture.
exactly. And seeing those different trends is often the first clue, like you said.
So how do these Q1 numbers stack up against, say, last year or even the last quarter?
Good question. That comparison gives us, well, a much richer picture. On the consolidated side, that nearly 1,478 crore revenue, it's a healthy jump, up from about 1,322 crore in the same quarter last year, Q1 FY25, and also up from the previous quarter, Q4 FY25, which was around 1,451 crore.
So growth both year-on-year and quarter-on-quarter for consolidated revenue. Nice.
Yes. And the consolidated net profit after tax also showed, a nice increase. But here's where it gets really interesting. Their total comprehensive income.
Yes. TCI. That includes things beyond just operating profit.
Exactly. Non-operating stuff like asset revaluations, currency effects, things like that. And this quarter, it skyrocketed to 308.90.
Wow. 308 crore.
Yeah. And get this. That's coming off a negative figure of about 62 crore in Q4 FY25.
Negative 62 to positive 308. That is a dramatic swing.
It really is. And it's also a strong improvement from the 236 crore they had in Q1 last year. It suggests, a significant improvement in their overall financial position beyond just profit from sales, a really strong signal on balance sheet health.
Okay, that's a major turnaround. What about the standalone side? Did we see that same kind of dramatic TCI swing there?
Well, on the standalone side, the story for operational profit is slightly different. Revenue was up compared to last year, yes, but it actually dipped a little bit compared to Q4.
Okay, so a slight sequential dip in standalone revenue.
Right, and the standalone net profit after tax, that was down compared to both Q1 last year and Q4 last year.
Okay, so standalone profit faced some pressure.
Operationally, yes. But interestingly, the standalone total comprehensive income also surged. It hit 266.33 crore, which is, again, really striking compared to that negative 29 crore in Q4.
So TCI recovery across the board, even if standalone operating profit was softer.
Exactly. So while the parent company's core profit might have hit some headwinds quarter on quarter, the broader financial health, boosted by those non-operational factors, saw a really significant positive shift overall.
Okay, so we've got the headlines, these interesting contrasts, and especially that big turnaround in TCI. But to really grasp Atul's profitability, we need to look inside the income statement, right? What's driving costs? What specific items stand out?
Right. Connecting this to the bigger picture, we can see some key cost drivers. Looking at the consolidated results for Q1, the cost of materials consumed was 791.09 crore.
791 crore. That sounds like a big chunk. How does it compare?
It's up from both the previous quarter and the same quarter last year. Now, this could mean a couple of things. Maybe input costs, raw materials got more expensive. Or it could just mean they produced and sold more stuff, so naturally needed more materials. Maybe a bit of both.
Okay, makes sense. What else stood out on the expense side?
Well, other expenses came in at 180.67 crore, and there's a useful note in the filings about this.
Well, as I
It clarifies that about 24.56 crore of that figure, specifically for this quarter, Q1 FY26, was related to things like application fees, cess, premium, stamp duty, all for converting some agricultural land to industrial use.
so not a typical recurring operating cost then, more like a one-off investment.
Exactly. It points towards investment in expanding their manufacturing footprint, which is, a significant strategic move, not just day-to-day running costs.
That's a great detail, highlights how digging into the notes is important. Anything else on expenses or maybe inventory?
Yes, actually. Changes in inventories of finished goods, work in progress, and stock in trade. It came in as a negative figure, minus 52.07 crore.
Negative 52. So that means inventory levels went down.
Precisely. They essentially sold more than they produced during the quarter, reducing their stock levels. This could mean demand was really strong, or maybe they were clearing out older stock. Either way, it often suggests, good efficiency and potentially helps cash flow.
Interesting. Okay, so we've looked at the overall numbers, some key expenses. Now, a tool isn't just one thing, right? They operate across different sectors. To really see where the action is, let's get into the segments. How did the different parts of the business perform?
Right, this is crucial. Which bits are really firing on all cylinders? Looking at the consolidated segment revenue for Q1, you've got three main areas. First, life science chemicals.
Okay, what's in there? Pharma ingredients.
Yeah, active pharmaceutical ingredients, APIs, and their intermediates. Also, crop protection chemicals. That segment brought in 449.20 crore in revenue.
449 crore. Got it. Next.
Next, and this is the big one, performance and other chemicals. It's a really broad category, things like adhesion promoters, bulk chemicals, epoxy resins, hardeners, various intermediates, textile dyes, a whole mix.
And the revenue there.
Substantial, 1,066.93 crore.
Wow, okay. Over 1,000 crore just from that segment.
Yeah.
Clearly the heavyweight.
Definitely. And then there's a smaller other segment. This covers things like agri-biotech, some food product services that contributed 16.36 crore.
16 crore. Okay, so performance and other chemicals is just miles ahead on the revenue front. Does that translate to profit contributions too?
It does, yes. If we look at the consolidated segment, results basically the profit from each segment for Q1 Life Science Chemicals reported a profit of 68.41 crore.
68 crore profit there.
Performance and other chemicals contributed a very robust, 100.0 crore in profit.
Exactly 100 crore. Okay.
And the other segment showed a profit of 2.34 crore.
So yeah, unequivocally, performance and other chemicals is the engine room, largest contributor to both the top line and the segment profit. Its strength is clearly vital for the whole company.
No question about it. It's the main pillar.
That segment, performance and other chemicals, it seems so dominant. What do you think drives its strength? And is there a risk in being so reliant on one large, diverse segment?
That's a very fair question. Its strength probably comes from its diversity within the segment, serving lots of different industries, maybe construction, automotive, textiles. So it might benefit from broad economic activity.
So diversification within the segment helps.
Likely, yes. It covers bulk chemicals right through to more specialized things like dyes and resins. But you're right about the reliance. A major downturn in global manufacturing, or say significant volatility in raw material prices that hits those specific chemical chains, could disproportionately impact a tool because this segment is so large for them. It's their strength, but also, something to watch closely. Concentration risk, basically.
Makes sense. Okay, moving beyond the operations. What about the overall financial health picture? What do things like the audit reports tell us? Can we trust these numbers?
Well, what's reassuring here is the process behind the numbers, and like you mentioned, the auditor's involvement. First off, the company's equity share capital stayed constant at 29.44 crore. Their other equity, consolidated, is very strong at over 5,500 crore euro, 5,569.09 crore to be precise.
Call it equity-based.
Very. And Deloitte, the auditors, did a limited review of both standalone and consolidated results for Q1. The reports are pretty standard but important. They state they didn't find anything causing them to believe the statements contain any material misstatement.
So basically, a clean bill of health from the auditors, no major red flags raised.
That's the takeaway, yes. No modifications noted. It definitely builds confidence in the figures they've put out, suggests good transparency and accuracy.
Now, you mentioned the consolidated structure is quite big. 43 subsidiaries, you said.
Yeah.
That sounds complex. Does it raise any issues when maybe not all those subsidiaries are reviewed by the same or any auditor? I saw a note about that.
Ah, yes, that's an important detail to understand. The consolidated results do cover a huge range of entities, those 43 subsidiaries, like Atul USA, Atul Europe, plus an associate company, a joint venture. It's expensive.
Right.
The auditors, Deloitte, did point out that the results include numbers from 3 subsidiaries that were reviewed by other auditors. That's quite common.
Okay.
But they also noted there are 36 subsidiaries and 1 associate whose interim financials were not reviewed by any auditors for this period.
36 unreviewed. Doesn't that sound a bit concerning? How could the overall numbers be reliable then?
It sounds like a lot, but the key phrase in the auditor's report is that, according to Atul's management, these unreviewed entities are not material to the group.
Not material. What does that actually mean in practice?
It means that, in the grand scheme of things, the financial size and impact of these specific subsidiaries are considered too small to significantly change the overall consolidated picture. Like, their revenues or profits wouldn't meaningfully move the needle on that nearly 1,500 crore top line or the 132 crore bottom line we saw. Auditors typically rely on management's assessment for this unless they see reason to doubt it. It's standard practice for large, complex groups.
Okay, so it's an accepted accounting principle, essentially, as long as their combined impact is small relative to the whole group.
Exactly. They're deemed insignificant enough not to warrant the cost and time of a full audit or review for the interim results from the perspective of the consolidated financial statements.
Understood. So pulling this all together, what does this Q1 report mean for someone trying to stay informed about a company like Atul? What are the key takeaways?
Well, I think the main takeaway is a strong consolidated performance overall for Q1 FY26, especially that really significant rebound in total comprehensive income compared to the previous quarter. That's a big positive signal about their broader financial health, not just operational profit.
Right, the TCI jump was striking.
Definitely. And the performance and other chemicals segment continues to be the absolute engine driving both revenue and profit. Its importance can't be overstated.
So looking ahead then,
Looking ahead, it really raises an interesting question, doesn't it? You've got this strong recovery in TCI. You've got the steady performance from that key chemicals segment. So how might a tool leverage its quite diverse portfolio? Remember the pharma ingredients, the specialty chemicals. How might they use that mix to tap into global trends, maybe navigate supply chain shifts to keep this momentum going? And what could that mean for their path forward, as this big diversified chemicals player? That's something to think about.